Oil remains the world's primary energy source and a cornerstone of the global economy. Over the next 15 minutes, we'll explore its supply dynamics, demand drivers, recent price movements, and the investment mindset shaping institutional and retail approaches. Total proven crude oil reserves stand at roughly 1.7 trillion barrels, enough to meet global consumption for about 50 years at current rates. Annual production averages 100 million barrels per day, BPD, sourced from Middle East OPEC members, Saudi Arabia, Iraq, UAE, Kuwait, Iran, collectively 30 million BPD. United States, 12 million BPD, led by shale basins in Texas and North Dakota. Russia, 110 million BPD, with upstream challenges from sanctions and aging fields. Canada, China, Brazil, and others, each producing 2 to 4 million BPD. Despite technological advances in drilling and enhanced recovery, supply growth has plateaued. OPEC's spare capacity hovers around 2 million BPD, limiting the market's ability to absorb demand shocks. Meanwhile, exploration budgets remain constrained by capital discipline, and new mega projects require 7 to 10 years from discovery to first production. Global oil demand reached 102 million BPD in 2024 and is forecast to hit 105 million BPD by 2026, driven by transportation, 55% of demand, road transport, gasoline, diesel accounts for over 40 million BPD. Aviation kerosene demand is 8 million BPD, rebounding strongly post-pandemic. Shipping consumes 5 million BPD of marine fuels. Industrial and petrochemicals, 30%. Refineries produce feedstocks for plastics, fertilizers, and chemicals, requiring 30 million BPD of crude. Petrochemical demand grows 3% annually with global manufacturing and population. Power generation, 10%. Oil-fired power plants use 10 million BPD, primarily in emerging markets lacking alternative baseload sources. Residential and commercial, 5%. Heating oil and lubricants consume the remainder, concentrated in cold climate regions such as Europe and Northeast Asia. Brent crude traded near 75 barrel for most of 2024, rising over 25% in 2025 to touch 95 barrel in September. Key drivers include OPEC production cuts, joint voluntary cuts of 3 million BPD since mid-2023 tightened balances. Geopolitical risks, Middle East tensions, and Russian export risks under sanctions kept markets on edge. Inventories and spare capacity, OECD commercial stocks fell to 5-year lows, shrinking the buffer against disruptions. Economic growth, emerging market demand outpaced expectations, offsetting mild demand softness in advanced economies. Unlike non-yielding commodities, oil prices also reflect inventory roll yields, refinery margins, and currency moves, especially the US dollar's strength. Institutional versus retail, contrasting approaches. Institutional investors utilize futures curve strategies, contango, backwardation, and crack spreads for returns. Allocate via energy sector equities, integrated majors, ExxonMobil, Shell, and E&P companies. Risk management through hedging programs covering forward physical sales and swaps. Retail investors access oil via ETFs, USO, UCO, commodity index funds, or energy sector mutual funds. Face roll yield drag in ETF structures. Simpler long-short products can offer leverage but amplify volatility. Can capitalize on directional price moves without complex hedging infrastructure. The oil investment mindset. For retail investors, a modest 5 to 7% energy allocation can diversify portfolios and hedge inflation. Be aware of roll yields, contango structures erode returns over time. Short-term volatility can exceed plus 30%. Position sizing and stop strategies are critical. For professional managers, energy exposure is part of thematic allocations. Decarbonization requires hydrogen, carbon capture, etc. Hedging benchmarks must balance market views with physical business exposures. Environmental, social, and governance (ESG) considerations increasingly influence capital flows. Key takeaways for oil investors. Supply discipline, OPEC plus control, and capital-constrained majors cap supply growth. Demand resilience, transportation, petrochemicals, and emerging market growth underpin steady consumption. Volatility and risk, geopolitics and inventory cycles drive sharp price swings, hedging costs matter. Structure matters. Contango versus backwardation in futures markets can enhance or erode returns. Strategic allocation, 5 to 7% energy exposure balances diversification benefits with market risks. Oil remains a complex, dynamic asset class blending industrial necessity with financial market intricacies. Whether for portfolio diversification, tactical trading, or thematic exposure, understanding oil's unique supply-demand structure is essential. Thanks for watching. Share your thoughts below, like, subscribe, and hit the bell icon for more energy market insights. See you next time.